We're going to look at Exantas Capital. And what we're going to do is we're going to value the company. We're going to enter their financial information into the model. Then the model will calculate the future free cash flows. And we're going to figure out the discount rate we need to apply to those cash flows using the company's weighted average cost of capital. And we're going to then compare our calculated stock price, what we call the intrinsic stock price, to the actual stock price and see if it's a buy or a sell. We're going to also look at their financial ratios. And I'm going to show you where I get all the information so you can do it yourself at home. So the first step, market cap is 91.6 million, very small company. And the stock price is 286. So now we know the shares outstanding. It's just a market cap divided by stock price gives you 32 million shares outstanding. And that's helpful because when we calculate the value of the company, we have to divide it by the shares outstanding to get the stock price. So now let's get the free cash flows. That's in Yahoo. In the financial section, go to cash flow. And then free cash flows, we'll just pull in 4 years of data. And if you want to calculate free cash flows, just go to the cash flow statement. It's operating cash flow minus capital expenditures. And anytime a company has positive free cash flow, that means they're increasing value to the company. They're adding to their assets. And when they have negative free cash flow, they're reducing value and decreasing their assets. So it's a really important number to look at. Next, we need net income. And that's on the income statement. That's the profit and loss for a given time frame. And we're going to get 4 years of data. And net income, it is possible to have positive net income and negative free cash flow, or negative net income and positive free cash flow. You can see right here in 2016, the company had negative net income, but yet it had positive cash, which means in that year, 2016, it added value to the company. It added $42 million of cash. Now, there could be a number of ways that happened. They might have taken out debt, and then that debt was cash that went into the business but didn't affect net income. Or they might not have taken any debt, and on the income statement, they might have depreciated some assets more aggressively that year, and it resulted in a negative net income. There's multiple ways that can occur. So let's look at the revenue. That's the actual sales for a given year, and that's the most straightforward number because it's just what the company sells. Either they sell products or services. This is a REIT, so what they do is they buy real estate, whether commercial or residential, and then they rent it out or lease it out to people, and they collect. Their revenue is the payments from the lessee or mortgager. So now that we have the financials in, the model has calculated the free cash flow. But we need the discount rate because every company has a different discount rate. And we have to figure out what their rate is so we can discount those cash flows and figure out what the value of the company is. Now, according to their income statement, they paid $84 million in interest on the debt payments. Now, Yahoo doesn't break down the debt. It just has one line item for liabilities. So I couldn't tell from Yahoo, so I had to go to the 10K. And they have $1.5 billion of debt. So that means they pay an interest rate of 5.4% on their debt. REITs don't pay taxes, so the cost of the debt is 5.4%. And you can see a whopping 94% of the capital structure is debt. That's a lot of debt. Now let's look at the beta. Let's get the cost of equity. The beta is 1.39. So the way we get the cost of equity, we use the capital asset pricing model. and it's just a simple calculation, and it comes out to 13%. That's what it costs to finance equity. So obviously equity is much more expensive than debt. It's more than twice as expensive. The reason is because equity is more riskier. In the event of a default, debt holders are paid before equity holders. And in order to get the weighted average cost of capital, the WACC, is just a blend of equity and debt, and that comes out to 5.82%. And this is the rate this company uses to discount its future cash flows. Or if it was taking on another project, its expected future revenue, it would discount using the 5.82%. Now let's see what the results are. We estimated 4 years of cash flow. And then we did a terminal value, which is all years past year 4. And the reason it's so low is because they have so much debt that this number has been reduced dramatically because the model takes into account the risk of the business. So when we discount those numbers back to today's value, we get a value of the company of $111 million. So when you divide it by 32 million shares, we get an intrinsic stock price of $348, which is higher than what is trading at $286. So it is trading at an 18% discount. So you can see the stock was trading way higher, but then it dropped dramatically, and now it's probably going to stay down there for a long time because I don't think people are willing to pay what they were paying $10, $11, $12 for the stock. Just because a stock or company's not doing so well doesn't mean a stock is a bad buy. We just saw it would hurt. They filed bankruptcy and their stock has gone up like 1,000%. So you have to not only look at how valuable the company is, you have to look at how much it costs to buy the stock and then compare the two. It's just like $1,000 is really expensive for a dozen eggs, but for a house it's really, really cheap. So you can't just look at how much something costs, you have to look at what you're getting for it and put those two together. And this is a risky proposition because this stock is obviously struggling a little bit. And I just added a feature to the model, and this is definitely a work in progress, as I noted on this footnote, because I just kind of built the model. It took me a little time to do it, to calculate the probability of default for the company. So this will change this calculation the more companies I look at. As the model has changed, it gets more refined the more information I have. But I was just using it on a bunch of companies, and based on my calculation, there's a 57% chance of default for this company. The way I calculate it is I use the interest coverage ratio, the percentage of debt, the market cap, the free cash flows, and the current ratio. And I kind of blend those all together and come up with a probability of default. So now that we looked at the intrinsic value, let's look at the ratios and compare them to other companies. So on the balance sheet in Yahoo, they didn't have current assets, current liabilities, so I had to go to 10K for that. But we need the equity and EBIT from Yahoo, so let's go there and get it. I try to do as much as I can on the video because I think it's important that you see how to pull these numbers so you can do it yourself. So equity is 556 million and EBIT is just your income before interest and taxes. So it's just their revenue because they don't really have any cost of goods sold. So it's just revenue as their EBIT. And current assets of 645 million. That's just their cash, accounts receivable, and inventory. They don't have this. They don't have inventory, so it's pretty much mostly cash, and some investments. The current liabilities is the debt, the short-term debt, because I don't think they have any payables. That's 621 million. The equity is on the balance sheet. That's the total assets minus total liabilities. So it's like the value of the firm according to the balance sheet. And EBIT is earnings before interest and taxes, or operating income. So now let's look at the ratios. A PE, price over earnings, I generally look for under 15 for a good deal, and this is a really low PE because the price has come down so much, so the PE has come down a lot. So it does look attractive on a PE basis. Price over sales, I like to see under 2.2. That says 1.6. It's stock price over sales per share. Price over book, it's a really, really low book. It would seem like a steal at 0.2, but you have to really understand the numbers and kind of look under the hood. And it might not be a steal once you realize how much debt they have. Because you could lower these numbers if you take on debt. So it might look really appealing to have a great PE, but that's just because you added tons of debt. And that's just kind of like bolsters up your earnings. And it just creates a lot of leverage. But the current ratio is good, 1.04. That means they do have enough assets, current assets, to cover their current payables. Low ROE, like most REITs seem to have really low ROE. I added interest coverage because I needed that to calculate the event of the probability of default. And what interest coverage is, and this is a good number to look at, especially if you're concerned about companies going bankrupt. It's EBIT over interest expense. So it's your earnings before you pay interest and taxes over the interest expense. Interest expense is interest on the debt, the $83 million. So if this is under I wrote 1.5 or lower, it's a problem. If it's lower than 1, it's a real problem, because they can't. The way companies go bankrupt is they can't pay the interest on their bondholders. That's pretty much how all companies go bankrupt. It's just they run out of money, so what they do is they take on debt, and then eventually they run out of money again, they take on more debt, and then they eventually get to a point where they just can't take on any more debt, and they can't afford to pay the interest on the debt. And once that happens, an event of default occurs according to the bondholder agreement, and they are forced into bankruptcy. So if they can't even cover their interest payments, if it's not 1, then they will go into default. The thing is, they'll just borrow more, but they're already highly leveraged. They already seem to borrow a lot, so it doesn't look so great. And I compared it to other REITs, and the only thing XAN is winning in is price to book, just because it has a crappy balance sheet. But you can see the other ratios, it just has so much debt, and everything is really low because they took on all that debt, and that makes this look more appealing, but it's kind of smoke and mirrors. So I added more color to the analysis than I usually do with the let me know what you think about the probability of default. This will get improved over time, because you could read information about how to analyze things, companies, or how to look at things, or you can read how to play poker or anything, how to learn a language. But until you start putting it into practice, like until I start actually looking at companies and seeing their default rate according to my calculation, and then seeing how it works and it doesn't work, it's going to just get better and better. But okay, thanks for watching. Have a good day.